welcome everyone. This is class number 8 of the July 2023 UBE crash course with Ibis Prep. I'm your host, Andrew. I'm joined by the one and only Matt Beckerman. And we started class today by going around the room and talking about different subjects we've done so far and quizzing the students. And I was really impressed by how well we know our material. We're going to continue this lecture by doing corporations, and corporations is a very interesting subject. So if we look at the updated calendar, we started with contracts, then torts, then we did property and con law, then we did civ pro and evidence. Yesterday we did agency and partnerships, and today we're doing corporations and LLCs. And Ibis Prep, this company, is actually an LLC, so we can talk about that as an example. We'll continue on with trust and wills next week, secured transactions. Then we're going to switch family law for MPT on the 25th. We'll take off for 4th of July, come back and do the crim pro crim law. Then we'll do family law and MPT, and then a week of general study, and then test day. So we're moving along swimmingly. I really think this course is great. It's our inaugural UBE course, and we're just doing a great job as a class. I think everyone in here should be in position to pass the UBE. So if we look at the materials, we can look at business entities and see that today we are going to continue the outline from where we left off, which is at corporations and LLCs. We talked about agencies, we talked about actual authority, apparent authority, inherent authority, contract liability. And remember in the essay, it was important that they were disclosed. Their name was on the business card. We talked about tort liability, vicarious liability, respondent superior, the detour versus the frolic, direct liability. This was a question that Matt asked. The principal can be directly liable for the agent's torts if the torts were committed within the scope of the agent's actual authority or were later ratified by the principal, or based on negligence if the principal negligently hired the agent, failed to fire the agent, or failed to properly supervise the agent. So that was some things that Matt highlighted. Talked about the fiduciary duties of loyalty, care, good faith. Partnerships can be formed by just, 2 or more people trying to make a profit. And we went into a lot of the requirements of partners and what they need to do. And remember, it's very important if you're a general partner or a limited partner, whereas general partners have the management duties and limited partners are more just limited to their personal investments in the company. So they're not personally liable to the extent past what they've invested in the business. I don't want to say company, I want to say partnership. So we talked about dissociation, dissolution. Dissociation is one member pretty much withdrawing, where dissolution is the winding up of the business. We talked about LPs versus LLPs. LPs are limited partnerships where there's at least one general partner, whereas LLPs are limited, everyone is a limited partner. And that pretty much brought us to here. So let's keep it moving. Corporations, nature and advantages, limited liability of shareholders, centralized management, continuity of existence, ease of transferring ownership, access to capital through the sale of shares. So I teach for the Series 7, and the Series 7 is all about stocks and bonds. That literally is the transfer of ownership of corporations. So me, Ibis Prep, I'm a business owner. I have an LLC, which is actually a tax election. I elect to be taxed as, I am a sole proprietorship that elects to have the liability of a corporation. So by being an LLC, Ibis Prep has flow through taxation, but we have limited liability. That's what an LLC is. It's an election. It's the exact same thing as an S Corp. An S Corp is a corporation that elects flow through taxation. So you'll see that S Corps and LLCs actually arrive at the same place. People ask me, why would you be an LLC versus an S Corp? And there's different reasons. I'm probably going to transfer to an S Corp in the future. Why? So that I can have shares, so I can have shareholders, so I can People can have shares of the company. These are kind of some thoughts. A C corp is what most companies are. They are subject to double taxation, and they have a limited liability. So if we kind of think about that lens of partnerships have flow through taxation, they're taxed at the individual level. They're not taxed at the entity level. They're just taxed once at the partner level, right? And especially general partners are subject to liability. So you have liability, unlimited liability, and you have flow through taxation. That's like the main partnership. A corporation is the total opposite. You have limited liability. If I buy stock in Apple, my losses are limited to the stock. I can't lose any more than that. And then there's also double taxation in the sense that I'll be taxed on capital gains, right? Like if my money increases, then they'll tax me because there's a capital gains taxes. And the company already got taxed too. So if you think about that, that money's kind of being taxed twice. So you don't have the tax advantages of being a partnership. That's why LLCs and S corps kind of fit nicely in the middle. They're elections so that you can elect the best case scenario to have limited liability and to have flow through taxation. So corporate earnings paid to shareholders are said to be subject to double taxation. That is income to the corporation and as income to the shareholder, right? It's taxed to the corporation and then it's taxed to you when you have capital gains taxes or ordinary income, if it may have been, or probably capital gains. Small business may avoid by electing taxation under subchapter S, which taxes corporate income directly to shareholders in proportion to their ownership, right? An S corp, it's an election that will make it so that you have flow through taxation. Just like an LLC is an election for a sole proprietorship to be taxed, to be liable like a corporation, to have limited liability. So we'll talk more about that, but corporate powers, corporations can act to sue and be sued in the corporation's name, lend and invest money, or even donate the money to charity, acquire, hold, lease, develop, or sell property, including ownership and other business entities, enter into contracts and incur debt, appoint and hire officers, directors, and employees. So corporate powers. They're liable for their contracts and for torts committed by their agents. A corporation may be held liable for punitive damages if an employer or agent engages in intentional misconduct or is grossly negligent and the corporation participates in or condones the conduct or is itself grossly negligent. So corporate formation, very important. We definitely have to have certain requirements, right? It has to have articles of incorporation, and there has to actually be incorporators, which can be a person or an entity. And the articles of incorporation have to have all these elements: the name, number of shares, initial address of initial registered officer, name of initial registered agent and acceptance of agent, name of incorporator, and address of principal office. They could include number of directors, par value of stock, imposition of personal liability on shareholders to a specific extent, initial purposes, and any other provision. So most times, like when I filed my articles of incorporation, I said Ibis Prep is created for the purpose of transacting business in the state of Florida. Generally companies will have a purpose, but it's not necessary. These things are necessary, right? The name, the addresses, and the people in the office location, etc. It has to be delivered to the Secretary of State. There has to be an organizational meeting to complete the organization of the corporation by appointing officers, adopting bylaws, etc. 2 days notice must be given to each director. Bylaws may contain any provisions for managing the business and regulating the affairs of the corporation. So the bylaws are like the corporation's rules. They're not necessarily filed with the state. The articles of incorporation have to be filed with the state. The bylaws could be internal, but a lot of times they are filed with the state. So we have different forms of corporations: de jure, de facto, and by estoppel. De jure is solid. It's like soup de jour, the best type of corporation. De facto means that there was like a defect in formation, but there was a good faith effort to do it. So we're still gonna try to recognize a corporation. Like I filed articles of incorporation, but I filed them inaccurately. It would still be a de facto corporation. And then corporation by estoppel, we'll always see this name. word estoppel means you're stopped from denying the existence. So someone who relied on a corporation being formed, even if one wasn't, there might be a corporation by estoppel, because that reliance, it would be unjust for them to deny the existence of the corporation. Yeah, someone's saying by law. I don't know what you mean by that.
De jure is by law.
Yeah, de jure by law, exactly. Like, it's just salad, soup of the day. All right, disregard of corporate entity. A court may disregard the corporate entity or pierce the corporate veil, right? This concept of piercing the corporate veil, there's a meme I always show people. One does not simply just pierce the corporate veil. This means there's two ways of thinking about piercing the corporate veil. One is, instead of going after the corporation, we want to go directly after the shareholders, right? So we're going to pierce the corporate veil and go after the shareholders directly. Another way is if a corporation sets up a subsidiary company that's really just an alter ego, and the only purpose of that company is so that when you sue the company, they don't have any money, then you could pierce that company and go after the parent company. So those are like two ways of thinking about it. Piercing the corporate veil, meaning going from piercing the corporation, going straight after the directors, or piercing the corporate veil, meaning piercing a subsidiary and going right after the parent company. Yeah, shell company, exactly, that's what we call it. So the alter ego doctrine, the court may disregard the corporation when the corporation appears to be the alter ego of the shareholders and used by them as a conduit for their personal affairs, right? There's no reason. It's just Matt and I have a corporation, but it's really just Matt and I, it's just an alter ego. Thin capitalization, they must have adequate capital to meet its reasonably foreseeable needs. So these are elements that would give rise to piercing the corporate veil. If they're thinly capitalized, if it's an alter ego. The deep rock doctrine, in a bankruptcy proceeding, capital contributions that are denominated as loans by shareholders of post-corporation may be subordinated debts to outsiders. Very hard concept, the deep rock doctrine. Have you ever seen that tested on the UBE essay?
I've never seen that, period.
Oh, all right, bet. All right. Subsidiary corporations, a parent corporation may be liable for the debt of a subsidiary when the subsidiary is inadequately capitalized, intermingled with the parent, or otherwise not a true distinct entity. So basically think of fraudulent purpose, alter ego, thin capitalization. These are ways you can pierce the corporate veil. You have any thoughts you want to add about piercing the corporate veil, Matt? It comes up a decent amount, I would imagine.
Yeah, I mean, in real life, it's pretty rare, but they do like to test it on the bar.
Yeah.
Like if you're not really like the point of a company is like to have a business that is for profit. If you're just using a company to get around like the laws for your own, not for the business, but for your own personal needs, then that's probably what they're looking for.
There's a book that I had to read on 1L year called The Buffalo Creek Disaster, which was all about piercing the corporate veil. And it was like a company that spilled, toxic into the water. They were to pierce that company and go after a bigger company. I read in Civil Procedures, a very tough class. Okay, capital structure. Capital structure refers to long-term investments of corporation, including stock and long-term debts such as bonds. Does anyone in here know the difference between stocks and bonds? Any of the students know the difference between a stock and a bond? If you have stock in a company versus you have a bond in a company, does anyone know the difference?
I think a stock is where you have an interest in the company. So there's a portion of interest that you own in the company. And then a bond is like I think it's like I'm not quite sure how to explain the bond.
Okay, but at least you're halfway right. A stock is ownership stake in the company. It's actual equity. And then someone's saying in the chat, a bond is like an IOU. I like that. A bond is like lending the company money with the expectation of being paying back plus interest. So you can make quote unquote interest off of a stock too. That would be called a dividend. But the real way people make money off of stock is by capital appreciation. So if I have stock in Apple, that means I own stake in Apple. And if the value of Apple goes up, then I'm an owner. Hooray, I own it. I have voting rights. Like I'm literally an owner of Apple. If you have a bond in Apple, you just lent Apple money and you are going to get paid back plus interest. Like every year you'll get paid back. So eventually you're over the maturity of your bond, you'll be paid back plus all the interest. So That's kind of how a stock and a bond work. Stock is a tiny piece of the proverbial pie. I like that. And a bond is lending them money with interest. There's two types of stocks. There's common stock and there's preferred stock. Most people own common stock. Common stock is like your natural way of owning a piece of the pie, as Paul said. Preferred stock is kind of a hybrid between a bond and a stock. It's technically a stock. It is ownership equity, but the real reason people own preferred stock is usually not for the equity. It's actually for the dividend payments. So that's why it's similar to a debt instrument like a bond, because it does pay you, consistently income. So trust me, I teach the 7 and the 66. I can teach all day about stocks and bonds, but just know at its basic level, stock is ownership and bonds are lending the company money. So agreements to buy stock is a contract under which the subscriber agrees to purchase a certain number of shares at a specified price. At common law, these agreements were revocable until adopted by the corporation. Consideration for shares. Shares may be issued for cash, other property, past services, or promises to perform services evidenced by a written contract. Shareholder liability. If a holder of a subscriber to shares pays less than the full consideration he agreed to pay, he may be held liable by the corporation and the successors and assigns, trustees in bankruptcy, and shareholders suing derivatively. Securities law. Stocks and bonds issued by a corporation must satisfy the requirements of the 1933 Act. For non-exempt securities, a registration statement must be filled with the SEC, disclosing all material facts. Sales of securities are also regulated through state blue sky laws, which impose standards governing the quality of services sold. So, little history lesson. 1929, there was this thing called the Great Depression and the stock market crashing, right? Governor Franklin Delano Roosevelt came in and passed, the New Deal or something like that.
Yeah.
Right. So he comes in and all this stuff. One of the main things was the acts of 1933 and 1934. 1933, also known as the Paper Act or the Prospective Act or the Truth and Securities Act, was a regulation that all IPOs or any PO, public offering, so someone's selling shares to the market, you're going to see Ibis Prep. I know about this because I'm playing it. When we go public, we're going to sell shares. Now, when Ibis Prep goes public and sells shares, under the Act of 1933, we have to issue a prospectus, which is a sheet that basically tells everyone about Ibis Prep and says, hey, this is the owner, this is how many shares we got, this is what we're doing, XYZ. Blue sky laws were enacted in response to certain things in the early 2000s, like Enron and Bernie Madoff and things like that. And
Lehman Brothers.
Yeah, Lehman Brothers, all that good stuff. So we have Sarbanes-Oxley and Dodd-Frank Acts, which basically are regulations that make sure that corporations are adhering to strict accounting procedures and compliance procedures. And anytime you see the word blue sky laws, just know those are state laws. Those are things that apply on the state level. Because when it comes to stocks, there are inter and intrastate securities offerings. Securities just means tradable financial instruments. So it could be a stock or a bond, could be literally a commercial paper, a check. It's just a security. But when you see that word blue sky, think of state laws. When you think of 1933, think of prospectus and having to tell people about the actual stock itself. Then they came out with the Act of 1934, which basically created the SEC and made it so that there's, rules for brokers and dealers and all these type of things. Okay. Preemptive rights entail the shareholder purchase a number of shares of new stock or treasury shares that are being issued sufficient to maintain a relative voting strength. Preemptive rights, I would consider anti-dilution rights. So let's say Matt owns 10%. Let's say I'm a great guy and all my top tutors get 10% of Ibis Prep when we go public. So I issue 100 shares of Ibis Prep stock and Matt has 10 of them. Matt's pretty happy. And then I say, you know what? I'm going to authorize 100 more shares. So that means I'm going to literally just create 100 more shares of stock. And Matt is going to be, wait a minute. Now there's 200 shares authorized of Ibis Prep. I used to have 10%. Now my 10 stocks out of 200 is only 5%. Well, that's preemptive right. He has the right to buy 10 more to maintain his proportional stake in the company, right? That's preemptive rights. You have anti-dilution rights. If they issue more stock, they can't dilute your share without you having the right to maintain your proportional stake. Any questions about preemptive rights, Act of 1933, stocks or bonds? All right. A corporation may acquire its own shares subject to the same limitations set forth above for other distributions. When the purchase is by installment, the effective distribution for purposes of two solvency tests is measured as the earlier of the date the money or other property is transferred or debt incurred by the corporation, the date the shareholder ceases to be a shareholder with respect to the acquired shares. It's just a kind of a point of law. So liability for stock transactions. A majority of courts today do not require insiders to disclose inside information to persons from whom they buy shares. An exception to the general rule is a special facts doctrine, under which insiders dealing face-to-face with shareholder sellers must disclose inside facts of unusual nature. So definitely important to know the 10b-5 rules, that tipper-tippee laws, and about insider trading. I'm going to give everyone a blanket thought. If they're acting on insider information, they're going down, whether they're the person who gave the information, whether they're the person who received the information. If they're just someone who heard about it and did nothing, then they're not going down. I probably hearing, I'm not gonna call myself out, but like, you know what I'm saying? Just because you hear something that you probably weren't allowed to hear isn't a crime. It's a crime if you hear something you weren't allowed to hear and then you act upon it. It's a crime if you tell someone something you weren't allowed to tell them. Insider information refers to, you know, if you work at Nike and you're in the boardroom and you hear that Nike's about to drop this new shoe with Michael Jordan, LeBron James, and it's like, it has their DNA in it and the stock's about to go crazy and it's not going to be public for 3 weeks. And then you go out and tell all your friends to buy stock in Nike, that would be insider information. A lot to talk about here, but you know, do you have any thoughts about, well, let me read this one too, section 16b. Requires that officers, directors, and 10% shareholders, control owners, return to their corporation all profit from any purchase and sale or sale repurchase of shares in the 6-month period. This requires no showing of bad faith or use inside and applies to publicly held corporations that have at least 2,000 shareholders. So that's just an idea of, if there's a big company and you are a main person, you own 10% more, or you're an officer director, then you're not allowed to take profit for the first 6 months. Basically, you have to have some good faith that like you're in this for the long haul, and you know you're not just gonna your shares are frozen for 6 months. So that's 16b-6, and then 10b-5 is insider trading. You have any thoughts about insider trading or any of this, Matt?
That was muted.
Paul says Wall Street, blue sky airline stocks explains it. Yeah, I mean, it's
I think the insider trading stuff is fun. It's interesting.
We could talk more about it when we do our outline, we go over essays, but I don't want to get too deep into it. So let's talk about promoters, what they are. A promoter undertakes to form a corporation and to procure the necessary capital and other items. Promoters must act in good faith and be in the best interest of all investors. A promoter who profits from a sale to the corporation may be liable to it for the profits. Promoters remain liable on contracts they enter on behalf of the corporation, even after the corporation adopts a contract, unless the parties agree to a novation. So promoters remain liable on contracts they enter into on behalf of the corporation. Promoters are the people who, you know, they basically take on the task of you know, selling shares before it's gone, before the sale has occurred. They're the ones who form the corporation. Like they're the ones who, you know, you usually, if you're a corporation, you'll hire promoters, and they're the ones who will do all the things to make sure that you know, get on the market. So the bar examiners often test on promoter liability. Remember that generally a promoter will be personally liable on a pre-incorporation contract unless the contract clearly negates personal liability, in which will be treated as continuing officer of the corporation. Even after the corporation is formed and adopts the pre-incorporation contract, the promoter remains personally liable unless there's novation, a specific agreement by all parties that the promoter will be released and the corporation substituted for the promoter. Yeah, like an agent, that's what a promoter is, like an early agent. So shareholders normally do not have power to control the day-to-day management of a corporation, but may be given management powers by the articles. Shareholders exercise indirect management by electing directors. So that's basically, if you own stock, you have pretty much one main right, which is to vote for the board of directors. You have rights to the meetings, to voting. You have the right to dividends if they're declared. You have the right to inspect the books. You have, you can establish voting trusts and voting agreements. You have no fiduciary duties. Derivative suits. So you do have derivative suits. A derivative suit is one brought by a shareholder to enforce a corporation cause of action when the board of directors for some reason has not sought to enforce the corporation's rights. So a derivative suit is suing on behalf of the corporation. The shareholder must first make a demand on the directors that they prosecute the suit. The shareholder must wait 90 days before bringing the suit unless the shareholder is notified sooner that her demand has been rejected. The delay will cause irreparable injury. If the corporation commences an investigation of the charges, the court may stay any proceeding for such period the court deems appropriate. To be eligible to bring a suit, the shareholder must have owned stock in the corporation at the time the action commences and when the alleged wrong took place. On motion by the corporation, the court may dismiss a derivative proceeding if the court finds that one of the following groups has made a good faith determination after concluding a reasonable investigation that maintenance of the derivative suit is not in the best interest of the corporation. Majority vote of qualified directors if the qualified directors constitute a quorum. Majority vote of a committee consisting of 2 or more qualified directors appointed by a majority vote of the qualified directors regardless of the quorum. A panel of 1 or more disinterested and independent individuals appointed by the court upon motion of the corporation. So this is shareholder derivative suits. Make sure you just understand that there are procedures where a shareholder can file suit on behalf of a corporation if the corporation isn't doing such. And then direct actions from a shareholder. A shareholder may maintain a direct action against another shareholder, director, officer of the corporation to protect the shareholder's personal interests. The shareholder must plead and prove an actual or threatened injury to the shareholder personally, an actual or threatened injury resulting from a violation of a statutory or contractual duty owned by the wrongdoer. So, so far, so good. Things you want to know about are how to form a corporation, filing the articles of incorporation, what corporations can do. They can sue and they can maintain suits. How you can file a corporation as a de jure, de facto, or by estoppel. The piercing the corporate veil doctrine, when you're either suing the board of directors or you're basically suing a subsidiary. What subscription agreements are, preemptive rights and securities laws of 1933. Insider trading, how we're going to find the tipper or tippee liable. A person who trades on material non-public information may still be liable even without a fiduciary relation to the corporation. A tippee is a person who receives the material, right? And then a tender offer. A tender offer is a public invitation to shareholders to sell their shares in the targeted corporation, usually at a premium over the market price. The Williams Act imposes anti-fraud and disclosure requirements on all tender offers involving more than 5% of the target stock. So does anyone know the difference between a merger and consolidation? I'm sure we'll get there, but just kind of seeing people.
A merger is where 2 companies or corporations come together to form one. And what was the other one?
Consolidation.
I think you're just trying to, your subsidiaries, you're trying to bring them all into one umbrella.
Yeah, exactly. A merger will be forming a new company. A consolidation will be one company absorbing another. Okay, we have board of directors. A corporation may have 1 or more board of directors. Directors are elected by plurality vote and must be 18 years of age or older. Directors may be removed with or without cause by the shareholders. Directors elected by a class of stock may be removed by a vote of that class. Any vacancy on the board is filled by the remaining directors or shareholders. So main thing, just has to be someone 18 years or older. Meetings. So, we just have to have meetings. Watch out for questions. And a quorum is a majority of the authorized number of directors. And usually you can vote by proxy. That just means remotely and just having someone vote for you. So watch out for questions testing the formalities of directors' meetings by setting up facts where there's no meeting. That is, the facts tell you that a director has entered into an extraordinary contract with another entity on the corporation's behalf, either on his own accord or with the approval of some of the directors, or with the approval of all directors who are called individually. You must recognize that a director does not have the power to bind the corporation on extraordinary contracts unless there's actual authority generally can arise if proper notice was given for directors' meeting, a quorum was present, and a majority of the directors approved the action. So what can directors do? They can manage the business, the power to elect and remove officers, declare dividends, initiate fundamental changes for submission to shareholder approval. Okay, duties and liabilities, same thing. Duty of care and loyalty, right? And we talked about this. The business judgment rule. Basically, as long as they're acting in good faith, we're not going to judge them if it was a dumb decision. We're going to assume that they know more than us, and we're going to give them a presumption of good faith that they acted in the best interest of the business, even if it didn't work out well. Duty of loyalty, they'll act in the company's best interests. It's implicated where the director is on both sides of a transaction, the director competes with the corporation, or the director usurps a corporate opportunity. Look out for that. A director usurps a corporate opportunity, taking personal advantage of something that a corporation should have taken advantage of. Interested director transactions are tested often. Remember, if a director will benefit from a transaction her corporation is about to enter into, the transaction can be set aside unless it is fair to the corporation. However, just showing that the director may benefit is not enough to set it aside. The corporate opportunity doctrine. Directors and officers must inform the corporation of business opportunities of which it might wish to take advantage. If a director fails to do so and personally takes advantage of the opportunity, she may be compelled to transfer the benefits to the corporation. Usurpation of corporate opportunity is a common corporation exam issue. Whenever the facts of a question mention that a director learns of a business opportunity, be sure to consider whether her corporation would have actual or expected interest in the opportunity. If so, she must present the opportunity to her corporation and can take advantage of it if it personally only can take advantage of it personally only if the corporation decides not to pursue it. If the corporation is not given a chance to take advantage of the opportunity, the director can be found to turn over the opportunity and or any profits derived from the opportunity of the corporation. Great example. Let's say Ibis Prep is now a corporation. And let's say Alexis, which she will be, is the director. Okay. Now let's say Alexis meets someone and they say, hey, I'm looking for bar prep for these, for this law school. And Alexis says, hey, I could do that, and just does it without doing on behalf of Ibis Prep. Totally a violation, right? She's a director of Ibis Prep. We do bar prep. She couldn't take advantage of that personally without saying, hey, Ibis Prep, the rest of us, do you want to take advantage of this opportunity? We say, no, you know what? We just don't want that. Then she could take advantage of it personally, but she does have to give us notice. Okay, so defense to accusations of disloyalty. A director can defend the duty of loyalty if, after disclosure of all relevant information, either a majority of disinterested directors approve the transaction, a majority of disinterested shareholders approve the transaction, or the transaction is judged to be fair at the time it was entered into. Here again, I talked about Sarbanes-Oxley's. That's, Dodd-Frank, Sarbanes-Oxley. Just know that there's strict auditing procedures. One of my good friends in Denver, that's what she does. I swear, she said she hates her job because she feels like it's useless, and it is. The only reason she does it is because these acts made it so that all companies have to do this. Now, is it useless? No, because a lot of companies were doing it fraudulently. But if they weren't, then yes, it would be useless. We could trust you. But now all companies have a duty to report, their compliance and accounting to basically to the SEC, so that we can make sure there's nothing going on weird. All right, a closed corporation. So these are, small corporations, basically, CHCs, fewer than a certain number of shareholders. It's 35 in Florida. I don't know what it is by state. Not publicly traded and subject to various transfer restrictions. They are typically run by family or close friends or business partners, and shareholders often have considerable amounts of their total worth in the companies. So these are closed corporations. And it says here that they're susceptible to deadlock and oppression. Deadlock occurs when shareholders are so divided that the corporation is unable to act, bringing it to a standstill, right? There's only two shareholders, 50%. Oppression, where majority shareholders in a closely held corporation abuse their power to benefit themselves at the expense of minority shareholders. This is especially concerning due to the minority shareholder reliance on the closely-held corporation and inability to easily sell their shares. Majority shareholders can stop giving out corporate dividends and instead create massive salaries for themselves, right? Oppression. All states allow for judicial remedies for deadlock or oppression in the event that private remedies, share buybacks agreements, for example, fail. These can include minor remedies like appointing a custodian to manage the corporation for a short time, or the extreme remedy of dissolving the corporation entirely. This is the most extreme remedy and only resorted to when all else fails. So we talk about amendments. Usually you're going to need a vote, right? A corporate may amend its articles of incorporation at any time. It must first be adopted by the board. The board then may recommend the amendment. The board may set conditions. The amendment may be approved by an absolute majority of titles of the vote of shareholders, or if it's a particular class being affected, just the majority of that class. Unless the articles provide otherwise, the board may adopt amendments such as extending the duration of the corporation, deleting the names of the initial directors, and making certain changes to the corporation name without shareholder approval. So now we talk about reorganization, right? In a merger, one of the combining corporation remains in being, okay, so we had this a little bit, and I thought Brandon, I was a little bit confused about this. A merger is when there's going to be one company absorbing the other, whereas a consolidation will be two companies forming a new company. So we had them backwards. So a merger is when one company absorbs the other. In a merger, one of the combining corporations remains in being and absorbs the other. Generally, directors of both corporations develop a plan of merger or share exchange. A short form merger involves the merging of a parent and subsidiary of at least 80% and does not require approval. So typically a merger does require shareholder approval. There's certain things that are always going to require shareholder approval, like a merger, for instance, like sorry, someone says something. Authorizing new shares, like not issuing new shares, but authorizing new shares that were more shares than were authorized in the corporate charter.
I think buying land.
What'd you say?
Buying land.
Yeah, buying land. The big one. What do people vote for? The big one is changed to the board of directors, right? They definitely get a vote on board of directors, but there's other things they get a vote on. Oh, another one that I just thought of is a stock split. If there's going to be some sort of stock split, they can vote on that. So triangular merger too, which is basically like they create a subsidiary, then the subsidiary absorbs one company, and then they like absorb the subsidiary. That's just a triangle merger when there's three companies. But just know that a merger is when one company absorbs the other. So I had that backwards earlier. I didn't mean to confuse people. Merger is when one company absorbs the other. Consolidation is when two companies form a new company. So yeah, they have a right of appraisal potentially, shareholder notice of intent to demand payment, corporation must give dissenters notice, shareholder must demand payment, and the corporation must pay. That's how a merger works. So we have voluntary dissolution. A corporation may voluntarily liquidate at any time with notice, or involuntary if there's a deadlock, there's waste, or there's fraud, or things like that. Claims against a corporation after dissolution. A claim may be entered against a corporation to the extent of its undistributed assets. If the corporation's assets have been distributed in liquidation, a claim may be entered against a shareholder to the extent of the shareholder's pro rata share of the claim in the corporate asset distributed to shareholder liquidation, whatever is less. Not for profit corporations, like you can definitely have a not for profit corporation, just means it's not for pecuniary gain. So now we have these different types of corporations. Remember the first thing I told you about was an LLC is relatively new and popular. They combine the partnership tax advantages, flow through taxation, with the corporation's limited liability advantages. LLCs have a filing of articles of incorporation, and then we can have members. An LLC must have a minimum of one member. So members can adopt an operating agreement. There are two types of LLCs, member managed LLCs and manager managed LLCs. Member managed LLCs are the default. If they don't specify, then we have it member managed. In a member managed LLC, the members act as agents with actual and apparent authority to act on the LLC's behalf. In a manager managed LLC, the managers are akin to the officers of a corporation, and the members are more like corporate shareholders. Managers or managing members in a member managed LLC owe the LLC the requisite duties of care and loyalty, though operating agreements can limit a member's required fiduciary duty of loyalty. So most of them are member managed LLCs. Like Ibis Prep is a member managed LLC. Literally, I'm the only member. And then a manager managed LLC would be like if there was managers who were managing, different people. They were like, if there was like a board of directors type, would be a managed member. A single member leaving the LLC does not dissolve the LLC. All members dissolve. LLC members are normally not liable for the LLC's damages or losses, except where the LLC is pierced, or proper procedures for dissolving and winding up the LLC have not been followed. All right, this was a lot, and I know people were like, holy moly macaroni, but we do have something that makes it a little bit simpler, and this is our questionnaire. So we'll try and do this efficiently, and then we'll take a break, and then we'll look at the 2 essays. So we did half of this yesterday with partnerships. We're going to finish up with corporations. So what's the definition of a corporation? I think a main important piece that we all want to state is that it's, double taxation and limited liability. Does everyone understand what that means? Double taxation and limited liability? Does anyone have a question about that? All right, so for S corps and LLCs, we're going to have flow-through taxation and limited liability. Does everyone understand what that means? Flow-through taxation and limited liability. Where can I find the outline for business entities? I'll send it to you, Nicole. We have a bunch of them. Distribution twice. Double taxation doesn't indeed mean that. It means that the company is being taxed, and it also means that the investor is being taxed. Because think about it. If you invest in Apple, well, Apple is taxed, and then they say how much money they made. And then based on how much money they made, that's how much your stock goes up. Cool, my stock went up. Well, then if you sell your stock, you get taxed on capital gains taxes. So you'll be taxed, the corporation is already taxed, and then you're taxed again as an individual. Whereas flow-through taxation, it's all one taxation on the individual level. Let's see, and just to help out right now, Nicole was asking if I could give her access to this. I don't know how I could do that. Oh yeah, sure. So most students already have access to this, but Nicole, is this you, Nicole Griffith? Yeah. Before I forget, this is our outline that is for the UBE. I have a different one for Florida, but this is a super solid outline. So I just gave you access. Okay, so we have S corp, LLCs, and PCs. We didn't really talk about it. Does anyone know what a PC is? My uncle's office is
A professional corporation only for like certain professions like lawyers, doctors' offices, those type of professional, and they're limited to just those individuals.
yeah,
Mixed
chartered, usually doctors, lawyers. Liability is limited to individuals. I like right, you're not liable for your other partners. You're running your own practice, but you're running it under the umbrella. It's only available to like certain professions. And then non-profit corporation is literally not for profit. Not for pecuniary. Yeah. Any questions about any of these different types of corporations? All right. So we talked about what are the requirements of the various business entities above and how they differ from each other. So how do you form a corporation? Filing what?
Articles of incorporation with the Secretary of State.
Articles of incorporation. Yeah. And just one other student was in Florida before I forget. Sorry. That's you, Scarlett. Anyone else, please just, I'll do this after class. Everyone else, if you're in these, okay. All right. So LL corporation by filing the articles of incorporation, exactly. What are the roles and responsibilities of partners, directors, officers in a corporation? So what are the roles?
So the board of directors is they direct and control the company.
Mhm.
The officers can enter into contracts on behalf of the company. Partners are agents of the partnership.
Yeah. We talked about that yesterday. I think that's out. All right, define the various fiduciary duties, duty of care, duty of loyalty, duty of good faith. We talked about this. Loyalty is avoid conflict and interest, duty of care, you're not gonna act prudently. And then put the business interest first and good faith, not act illegally. Business judgment rule we talked about, duty to act in the best interest of the partnership or the corporation. And it will be protected if it turns out to be a poor business decision as long as in good faith.
Yeah. So anything that you do is assumed, if you're a director or an officer, anything you do is assumed to be in the best interest of the company. And anyone who's trying to sue you for, violating duty of loyalty or duty of care, or duty of good faith, has to affirmatively show that you were not acting in the best interest.
Okay, what rule is used when determining whether there's a conflict of interest?
I think there are multiple.
All right, what you got first, Matt?
The first is if someone shows there's a conflict, and the burden shifts to you, the officer, to show that it was fair. Like if you hired your friend's company to do something for your company, you have to show that like the rates were reasonable, the hiring process was reasonable, like they're qualified to do the job, etc. So it's very like fact specific. And then I guess corporate like usurpation is a little different, but I learned them under like the same umbrella. So if you're an officer, you have a duty to not seize opportunities for your company for your personal benefit. So only way you could do that is if you personally disclose it to the board first, or could be disgorged. Could you elaborate on that, Paul?
No, I get what he's saying. It could be disgorged, meaning like if you usurp a corporate opportunity, you could be disgorged that.
Yeah, but I think like you'd probably still be kicked out.
Yeah, or like if Matt, you're an officer of Ibis Prep and you have an obligation to bring opportunities to us and you take on some contract for bar prep, you probably are going to be disgorged of that contract and we would take on that contract. Like that's what they mean in that.
Yeah.
All right, so corporate usurpation, the duty to not seize opportunities for your company for your personal benefit. Okay. What's the difference between direct and derivative suit? Can anyone out there tell me? This is a good question. A direct versus derivative suit. Direct versus derivative. Any ideas? Yeah, direct is shareholders versus other shareholders, officers, directors, etc. And a derivative is suing on behalf of the corporation. Excellent. All right. What is 1933 versus 1934? So 1933, what do all require?
Disclosure.
All registered securities require disclosure, which is known as a prospectus. And 1934 created the SEC, which includes broker dealers. Right. So if you get your Series 7 or Series 66, you could become a broker dealer, and that's in accordance with 1934. If you find out that practicing law isn't good for you and you want to go into finance, I can also help you pass that test. What are the issues surrounding insider trading? Write out everything you know and think might be important for the bar. All right, Matt, how about you tell us everything you know that might be important for the bar?
About insider trading. So
Yeah.
there are two main types: the normal kind, and then misappropriation. Misappropriation is a little more obscure. Misappropriation is not when you're like, you might not even be like an insider in a business. You're probably an outsider, but you have some kind of source. I think like the only one that comes to my head right now is if you're like an investigative business journalist, and you're like, you get a source from your boss, like the newspaper company, and instead of using the source to like do your investigation, you use your source to profit. That would be misappropriation, even though you're not actually an insider. Yeah, and then for regular insider trading, that is when you have some kind of so this all insider trading like all derives from fiduciary duties. When you're an insider, you have a fiduciary duty to the shareholders and to the company to not personally profit off of the company's business. If you want to trade on big news that's happening to your company, you have to wait until it's publicly released.
Is this 10B, this tip or tippy?
Yes, going very fast.
Yeah. We were talking about
10b5, yeah.
yeah, 10B5, that's right. All right, that's what I thought.
And
Okay.
then tipper tippee, like the tippy's liability derives from the tipper's liability. Everything's derived.
All right. What happens before and during an IPO?
Well, before the IPO, I think like individual people are reached out to, and they're asked if they want to buy into the company.
Yeah, investors are solicited, sent prospectus. After.
Anyone can buy.
Yeah. Anyone just stuff. Usually IPOs, I'll just give everyone a little bit of background information like, whoa, I want to participate in IPO. Can you? Usually IPO participation is limited to accredited investors. An accredited investor, I believe the standard is someone who makes over $200,000 for the past 2 years or has a net worth of over 1 million, not including their primary residence. But that's just so you know about IPOs. It's just initial public offering. Right now, I'll give you the trajectory of Ibis Prep. We're a little LLC. We're going to become a corporation, and then we're going to have an IPO. And we have an IPO. That means we're going to sell stock to everyone. How much stock am I probably going to sell? 49%, right? I'll retain 51% of company and then sell 49% for everyone else. All right. What are liabilities, if any, are owed by a promoter? Does anyone remember a promoter? Owes a duty of good faith, I like that. And the important thing, they remain liable even after the corp has been formed unless novation. They test that a decent amount that the promoter is still liable for. So when does a corporation dissolve? when does a corporation dissolve? Yeah, naturally,
If the legal purpose is to achieve profit, which most of them are, then it's not really ever achieved.
right, so,
So I guess naturally is very rare.
and how do they mostly dissolve, Matt?
When the judge gets sick of them and says this can't exist anymore.
Right, again, Ron. Okay, what are the rights and obligations of partners, officers, and shareholders during dissolution?
Well, I think creditors have the most like they have.
Yeah, let's talk about liquidation priority. Does anyone know who's gonna be, that's a great question. Let's talk about liquidation priority.
Yeah, creditors.
So general creditors. And then general debtors, right?
And also, like, yeah, people who have priority stocks have greater rights than people
So
who have common stock.
number one, taxes, wages and taxes is gonna get paid first, right?
Yeah, of course.
You're gonna have to pay off Uncle Sam, and you're gonna have to pay off the people who work for you. Then I actually think debtors are gonna be paid off before creditors, right? General debtors, then general creditors. Then we're gonna pay off debt holders. So bonds. Then we're gonna pay off equity holders, and in order, preferred stock, and then last, common stock, right? That's a key piece, that common stock is gonna get paid off last. So if you're a common stockholder, you have what's known as junior liquidation priority. Sure, just saying wages and taxes to employees in the government. Yeah, meaning like, let's say Ibis Prep goes bankrupt, or we have to liquidate, and Matt Beckerman is still owed his wages. I have to pay him first. And then let's say Ibis Prep owes taxes to the government. I have to pay them off too before I start paying off,
General creditors.
yeah, general creditors, debtors, etc. Okay. What is the dissociation of partnership? Does it mean to pierce the corporate veil, and how does this happen? All right, I like that.
I
Alter
think Paul
ego.
was answering the second question.
So also just like using it as a conduit for personal affairs.
Yeah, exactly. So company time.
Yeah, also like not obeying corporate formalities, like not having the required meetings, not having directors, just like not even like
Yeah.
having to go through the motions of what a corporation is supposed to do. Yeah.
All right. Excellent. So it goes employees, government, creditors, debtors. Well, think of debtors are usually paid off before creditors, in the sense of like, people who have lent you money, you have to pay back before people that you owe money to. But also know that bondholders who are debtors to the company will be paid back before stockholders. So if you have a bond in a company, you'll be paid back before stockholders. And if you have stock in a company, will be paid back before common stockholders. That 3 and 4, creditors and debtors, kind of goes like slashed next to each other. Those are just general people that the company owes money to, not including its holders, right? So it's like employees, government, outside people, and then we're going to pay back the stockholders. And even amongst the bondholders, there's a discussion about secured versus unsecured bondholders, right? Like secured bonds will get paid before unsecured bonds. An unsecured bond is also known as a debenture. So a regular bond will get paid back then unsecured bonds, then stock, finally common stock. So there's a whole hierarchy, but yeah, employees in government are kind of neck and neck. Outside creditors and debtors are kind of neck and neck, and then it goes strictly bondholders, common stock, or preferred stockholders, common stockholders. Okay, I think every other question, yeah, we answered every other question yesterday. It was all about partnerships. Any questions at all that anyone has about corporations? Any questions? All right, this was, a lot to think about, but we'll go ahead and take a 15-minute break.